Hey guys, welcome to another Ultimate Edge webinar series with Bay Equity Home Loans. This is a fun one for me, kind of a special one for me because we get a regulator. This is Chris Romano's with us today. Chris is with the state of Montana. He is the Non-Depository Bureau Chief with the state of Montana, which means that he is the guy that comes in, does examinations on companies such as ours when there's everything that needs to be examined, right, Chris? Is that kind of it?
No, you're spot on with that, John. You're right.
All right.
Yeah.
For full disclosure, the connection I have with Chris is he is married to my niece. And so I've known Chris for a long time. I know him to be a really straight up kind of guy. He's been with the department in Montana for a long time. He's overseeing nationwide examinations and stuff. He's got a lot of experience. So we invited him on so he could give us the benefit of that experience when we talk about all kinds of good topics. So thanks for joining us, Chris.
Thanks, John. I appreciate the introduction.
Yeah, well, let's do this, Chris. Tell us a little bit more about your background for the audience sake, where you came from, how long you've been with the department, and how much in regulations, anything that might be relevant there, please.
Sure. I've been working for the state of Montana Division of Banking for almost 20 years. So that means I kind of arrived pre-NMLS. So back in the day, it seems like the prehistoric times, back when states, there was kind of a patchwork quilt of regulations at the state level, not near as much consistency. And, you know, back then, if you wanted to see if a mortgage loan originator was licensed, perhaps there was no licensing in that state. And if you wanted to figure it out, you probably had to you might have to pick up the phone and call the state to see if they had licensing. If you were lucky enough, maybe they had it posted to their website. So I've been around for kind of a long time, focused heavily in licensing and examinations. Prior to joining the state of Montana, I had worked for my father, had a mortgage broker business. I grew up in Connecticut, and I worked and was around that as a kid growing up, and then eventually worked as an originator for a period of time before moving out to Montana and eventually starting to work for the state.
Okay. So some pretty deep history there, guys, from mortgages into regulatory stuff. Chris, can you describe for the layperson, like not someone who's been in the mortgage industry for 25 years like myself, what's the relationship like between you, a regulator, and a typical mortgage company? Is it adversarial at times? Is it just partnership kind of thing? Or how would you describe that, please?
You know, a typical relationship would be non-adversarial. I mean, we would like to be a resource. I mean, we're all, I think we're all trying to strive for compliance. The reason why we exist as a regulator is for consumer protection. And, you know, we understand that I think, you know, the vast majority of lenders and brokers that are out there are trying to serve their customers well. And, you know, we're trying to guide, you know, the industry really in the interest of helping and support the consumers. And obviously from your perspective, we know you're trying to assist and give good customer service to your consumers as well. Ultimately, there are instances sometimes we do end up in adversarial relationships, but with, you know, maybe sometimes some of the brokers and lenders that we regulate, but you know, that's in a really, I would say, a small minority when you look at the whole population of all the companies that we examine. Sometimes those relationships sour because of, you know, there's always a few bad apples out there, and inevitably sometimes that can, you know, spoil reputations and is unfortunate, but sometimes we do have challenges. But, you know, whenever possible, we're trying to work with, you know, work with the companies we regulate. And we, you know, that really spans a wide sophistication. You know, we work from everyone from small, you know, one person mom and pop type, you know, broker operations to, you know, your mid-size to really large size, you know, companies out there that exist really at the top level amongst the non-bank lenders as well.
Okay. Now, there's an act called the Dodd-Frank Act that we are very familiar with. Chris, maybe you could define what that was, the CFPB, how it got created, a little bit of history there so that also the layperson kind of understands how things may have changed in the regulatory environment and the relationship between banks and lenders, mortgage banks such as myself, prior to Dodd-Frank and since Dodd-Frank and where we're at now.
Sure. And, you know, I was fortunate enough to be working as a regulator kind of throughout all of that process in the prior decade in the early 2000s. So, you know, there was a lot more kind of explosion of subprime mortgages that were made. U.S. Housing prices started to crater. That in turn ended up kind of creating a liquidity crisis for a lot of the global financial firms that were had substantial holdings in mortgage-backed securities as mortgages started to go into default, and the number in default really started to increase exponentially. We kind of start to forget some of the stuff because and history tends to repeat itself. But looking back, you think about the fall of Lehman Brothers was like the largest bankruptcy in U.S. history. Bear Stearns collapsed. Remember there was the I think a $700 billion taxpayer-funded bailout that the Treasury Department administered, and it ended up was kind of a big wake-up call for there needing to be more regulation. And really, I read one thing and I thought it kind of surprised me that Dodd-Frank was probably the most significant U.S. regulatory reform since the Great Depression. And you think that was a pretty long span of time, especially in the financial markets, when you look back to how 30s with the Depression all the way to around 2008, 7, 9, 10, in that time frame when everything started to kind of unravel to when Dodd-Frank was passed. And you did reference to one of the things that was created. I mean, it's not often that you have it's new entire agencies created, but one of the things that was born from Dodd-Frank was the creation of the CFPB, or the Consumer Financial Protection Bureau. And obviously that's it's a significant watchdog and another big kind of power player in the federal landscape amongst the federal regulators too.
Right. Now, do you have direct interaction with the CFPB?
I do. We do amongst the states, there's a lot of coordination on examinations, and we do collaborate and do some joint examinations with the CFPB. We also strive for kind of information sharing. So there's an exchange of information kind of back and forth and keeping each other informed and sharing examinations. So we, are kind of better. So there's more coordination amongst the regulators of kind of understanding maybe in some cases where problems lie. And also, we take into account if the CFPB is, their examinations are substantial and are very significant. So certainly we want to take those into consideration and not try to at times create a regulatory burden on companies, and take into consideration, the significant amount of effort and work that goes into the CFPB exams to kind of recognize those findings as well.
Okay. So, Chris, does the CFPB do their own examination, and the Department of Financial Institutions and their state ones do their separate ones?
We do. We issue separate examination reports, and we might at times do kind of a concurrent examination where there's a level of cooperation where we might go in at the same time potentially and this typically would be for more mid-sized to larger scale-sized entities. The CFPB is not going to go in and do like a examination of a really small broker or lender. I mean, maybe the only exception would be is if they're doing something for cause, if there's some huge red flags or potential for consumer harm that they suspect.
Okay, got it. I don't know how much you can chat about this, but let's start here. What triggers an examination of a mortgage company, and is there a difference between an examination and an audit, those two terms?
So for an examination, most typically, just like I would say, there's only usually a few bad apples amongst a lot of licensees. Most examinations are routine, meaning states typically strive, and it's kind of a best practice for examinations to be conducted, I would say generally at least every 60 months or 5 years. That span of time might be more frequent based upon risk profiling that states might do, depending upon their review of how past examinations have gone. Maybe if they're looking at what the loan volume is of a particular company, and trying to weigh all those factors. There are, at times, sometimes there can be, complaints filed by consumers, or maybe some other states' examinations that are shared that regulators become aware of, maybe some findings and issues that are identified that might prompt to go in, maybe sooner, or kind of maybe more for cause, maybe kind of classify it that way. the examinations, primarily the focus typically is obviously consumer protection, heavy emphasis on transactional testing or loan file review. That's kind of
Okay.
typically kind of your most foundational aspect of the exam. There's usually too an evaluation of the company's management and their overall compliance program, and then also looking at the company's financial condition and kind of overall health as well from a financial standpoint.
Okay.
Audits, we do not, that's one distinction we make, is that we are not like CPAs, so we don't do an audit. It's more classified as an examination. Sometimes, just to mention too, sometimes there could be investigations, and investigations would be more something that would be characterized for cause. If there's a specific trigger, maybe, again, maybe consumer complaints that have been filed, maybe examination findings or practices that have been maybe discovered and shared by another state regulator or a federal regulator, something along those lines.
All right. And when you do an examination, what's the actual logistics of what happens there, Chris? You go in and pull loan files and start looking at them and all of that, or how does that all work?
So usually, I mean, a lot more examinations it seem like they've evolved to being more desk examinations than on-site examinations. I know for
Okay.
us in Montana, probably the vast majority of exams that we do, we're doing from the office, meaning we're initiating by, sending the company, reaching out to the company by phone or email, letting them know, okay, we're going to be conducting an exam. You can expect to receive like a forthcoming information request. So usually begins with a notification, an initial information request, kind of almost like a questionnaire of sort that the company needs to provide information. Typically at the onset, we'll ask for a loan list. And once the regulator gets the loan list, they'll make a loan file selection. So as part of that process, there's usually kind of a judgmental sample that the regulators will do. They might have some parameters, maybe minimum, say, okay, we're at a minimum every exam, we're going to review 20 loans, or, depending upon what the scale and the size of the origination volume is, we might ask for more. Typically, we'll weigh different factors and trying to get a representative sample of maybe requesting loans from different branches, making sure to maybe request loans across different MLOs, different loan characteristics and criteria, different loan products, loan programs, that you'd want to just take a good sampling of, in the case of with a mortgage lender or broker exam.
Okay. And to compare this, when I look at a loan application and somebody wants to qualify for a loan, I immediately look at credit, I look at assets for the down payment, and I look at debt to income ratio. So there's three quick things I can look at to see if we think we might have a loan here or not. Do you have similar parameters when you're doing an examination that you look at on a loan file? Because you're looking for more like fraudulent activity, is that correct?
Potentially looking for fraud and in large part compliance. So, weighing kind of our own state laws and requirements, and obviously the federal laws with, RESPA, Truth in Lending, Equal Credit Opportunity Act, some of the, the main, obviously, federal regulations, heavy reliance on compliance. One thing I would kind of characterize and say is typically we do not, underwriting requirements aren't legislated. Usually that's, handled by, you're complying with like the GSEs or, whatever the secondary market requirements are most typically that lenders are complying with. But so during the part of the review, we may ask to see components of the loan file or ask for a full copy of the loan file. But, we typically are not setting, we don't set underwriting requirements, and those aren't set by law. And usually, good business practice is to make good loans. So that risk is kind of taken on by the lender and not something that's, typically, again, legislated through state laws or federal laws and rules.
All right. And before we leave this topic, Chris, I don't know if you can share anything. I think the findings, once you find a company has some kind of violation, they become public findings. Is that correct?
Typically, examination reports are confidential, typically.
Okay.
So, not usual routine examination, there may be some findings. The company always has an opportunity to respond, be able to take some corrective action if there's something that needs to be corrected. Let's say if there's an overcharge, maybe there needs to be a refund made to a borrower. In some cases, if there can't be anything corrected, let's say a disclosure was missed, a time frame was missed, acknowledgement of, okay, we need to strengthen maybe our policies and procedures around this and educating staff. And most heavily weight, findings that would result in consumer harm. There's also things that would be compliance driven that you'd say, okay, doesn't have like a monetary maybe impact on a borrower, but from a business practice standpoint, maybe something was missed that should have been done, whether it was getting a disclosure out in time or maybe record keeping requirements, things like that. But the actual examinations reports in most states typically are actually protected and are confidential under state law.
Okay.
What could happen, if an examination, let's say, doesn't go well, there's always a potential where it could result in enforcement action, and kind of go through some process where there might be some type of agreement. It could lead to fines or restitution or something. In those instances, depending upon what route is taken through the enforcement process, those enforcement actions could become public potentially, and could be something that a company would need to disclose, if like on the NMLS with their disclosures to other regulators.
All right. And is there any trend line you see happening, Chris? Like I would expect actually since Dodd-Frank and that the amount of fraud has really decreased in the industry a lot. Are you seeing any little bumps or anything like that, or how would you assess that?
I think that's a good characterization. I think we've seen, I think the laws tightened up so much that almost could compare it to kind of driving on the road where there was no guardrails. And with all the regulations that have been put in place now, I think there's much more of a boundary or guardrails that have been put in. So the parameters are tighter. And I think we do, by and large, see much greater levels of compliance. And, the areas maybe we do see have some findings have tended to have less maybe consumer, negative possibilities of consumers impacting consumers than maybe prior to like Dodd-Frank. So, and in terms of trends, I think right now, the one thing as a regulator that we're looking for is, we know right now with the rising interest rate environment that, it's not as easy to drum up loan activity. And,
Right.
and when you enter those periods, that's when, lenders or the secondary market, might become more creative because they're, say, as a best practice, probably always best to display your NMLS ID number, or just make sure you have that information on there. Most states would expect to see it, and you can probably avoid some issue by at least including that.
Absolutely. And so for you all to understand, part of the regulations now, since Dodd-Frank was implemented, require that me as a loan officer, anybody who's licensed in a non-depository institution in particular, has to get continuing education every year. There's a number of hours for every state that you're in. And the emphasis is almost always on regulatory items and making sure you're advertising properly and making sure you're not stepping over the line someplace inadvertently maybe and doing something wrong. So they do their best with the educational requirements every year to remind us of what we need to be aware of here so we don't find ourselves in hot water. And I think it's been really, really helpful. Every time I go through it, I go, oh yeah, let's try to be really careful. Not that we're not, but it's just really good to bring it to the top of your mind through that continuing education process. That's been good. Chris, you mentioned early on that sometimes you'll do an examination because you'll get feedback from another state on a company. How much interaction do you have with other state regulators?
We have quite a bit. And I would say, what you're understanding the NMLS, what the NMLS is to licensing, there's a kind of a companion system to the NMLS. It's called SES.
Let me just interject. The NMLS is the National Mortgage Licensing System. That's what we have to go through as a loan officer to maintain our license. So go ahead, Chris. I'm sorry.
Yes. And with that system, now, regulators can kind of see in real time where all companies, individuals, branches are licensed and can kind of see the license status. We have kind of full transparency. So, if you're applying for a license in Washington and Washington sets a whole bunch of license items, we can see exactly what those are. There's kind of full transparency. So you kind of know, what the status of everything is. So with examinations, there's kind of a companion system. It's called SES, the state examination system. Kind of what the NMLS is for licensing, SES is for examinations. So
Got
it's
it.
a kind of an internal platform that states use to conduct examinations. States can communicate with the companies through SES, similar to how you can communicate with companies and individuals through the NMLS. And there's kind of full transparency though. So if I'm if I'm targeting a company to examine, I can also see in SES what other states are doing examinations right now. And it helps to further kind of promote sharing of data, because you can request that a state share their report with you, so you can kind of have a better insight into that process. Whereas kind of prior to that, you'd have to maybe send an email to another state or pick up the phone and say, hey, if you've done a recent exam, could you share it with us? It was a lot more of a cumbersome process. That SES system can be used for processing of complaints as well. You can, not that the consumers can't log the complaints in, but once we get a complaint, we can log it into the system and send it to companies. Companies can respond directly through it. SES is still more relatively in its infancy. It's only been used for a few years, so not all states are using it at this point for their examinations, but some states are. Also same for complaints. So if you are a mortgage company, you may not be, you might have an examination where the state's not doing it through SES, but it is, just at the beginning of the NMLS, not all states use the NMLS. There was kind of a phased in approach. People forget that. You kind of forget and think, oh, everyone was always on the system. No, it took time and momentum. In that case, there was a lot more momentum behind it because the passage of Dodd-Frank, and there was specific requirements with the SAFE Act that passed that mandated use of a system. So states were kind of pretty much encouraged to say, if you want to preserve your state's authority over the mortgage industry, you need to get on to the system.
Okay.
We don't have that in this case, so it's encouraged. So it's a little bit slower to evolve, but I think as each year passes, more states are using it, and it's a good tool for regulators, because just, one of the things we're trying to do is, it's hard to cover a lot of ground with all the exams we have to do. It gives us an ability to leverage and accept other states' exam reports. So if we see a company is doing a good job in complying, and let's say, there's been 6 exams in the past 6 months and they've all gone really well, we can see the reports, there's no significant findings. We could opt to say, we're just going to accept another state's exam and pass over and not do an exam altogether. Or we could leverage it and say, we're not going to look at the financials. We're not going to look at policies and procedures. We're just going to hone in on requesting a few loan files, because we can see that other states have looked at these areas and have all, not uncovered issues, or rated the company as doing a good job in those areas. So, I think for the good companies, for the companies that are doing a good job with compliance, I think it should reward them for that, try to help to reduce that regulatory burden.
Yeah, and conversely, if you see that there's been some sloppiness or maybe some problems with other examinations, you might want to be a little more proactive in examining companies within your own state that have that, huh?
Yes.
Well, that makes sense. It's good. Well, it's good to see our tax dollars at work and making it more efficient here, Chris. We're pleased to see that. Chris, you've really been great sharing your time with us today, over 45 minutes. I really appreciate it. I told Chris it was going to be about a half an hour, so here we are still chatting. Thanks so much. I really, really appreciate it.
Sure. Have a great day.
Take care.
Thanks, John. Okay.